All right, friends. Hey, how are you feeling today? Welcome to today's training. Oh boy, we got good stuff to talk about today. Today we're going to talk about asset allocation for option traders. If you can hear me, please hit that Q&A box and let me know you can hear me. Will you please? Please. Inquiring minds want to know. Give me a big old yes. Hey, Tomas, Mike, Michael, Philip. All right. Justin, KS, anonymous attendee, secret agent man, Shane, Kengo, and WK, and Monty. All right. Now, before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we are doing here is providing generalized information, which is not specific to your individual specific situations. Now I see some old friends here, but I see some new friends here as well. So let me introduce myself for those of you who are not familiar with me. So my name is Dan Passarelli, and I am an author of two of the most popular option trading books. Trading Option Greeks is the one I'm most known for. And I am a trader. I traded many years as a professional trader down on the floor of the Chicago Board Options Exchange, traded on Chicago Board of Trade, CME Group, traded upstairs. And now I trade in a retail trading account just like you. And I'm also the founder and president of Market Taker Mentoring, which is the global leader in option trader education. And I work with a lot of the groups in the options industry that are good actors in the industry. Great options friendly brokerage firms like Firstrade, as well as some other brokerage firms and some other exchanges. Most of the options exchanges, if not all of the options exchanges, all the ones I can think of, I've at least had some contribution to. And outside of options, I'm a family man. I'm a father of two humans and two little dogs, and married to my wife, Kathleen, who many of you know. Those of you who are Market Taker students have interacted with Kathleen. Kathleen runs operations here at Market Taker. And besides family and trading, I have other fun too. I am a runner, a foodie, a traveler. I traveled quite a bit all around the world, musician, and I'm always doing some kind of crazy stuff. In the process of building a garden, which is taking a lot longer than I thought it was going to. Now, for those of you who are new to the Market Taker family, we have a whole bunch of great stuff on our website that you can get for free. All you have to do is go to markettaker.com and go to the upper right-hand corner here and click on Join Free, and you will get lots of great stuff. You'll get some free classes. It's especially good for people who are brand new to options. But even the really experienced folks, you get special invitations to our very in-depth online webinars and online trainings. So make sure you do that. Now let's talk about managing capital. That is where we're going to start when it comes to what we talk about today. So there's this thing called margin. All right. Now, margin, like if you're newer to options, you've probably heard of buying a stock on margin, right? When you buy a stock on margin, what you're really doing is borrowing money from your brokerage firm to buy the stock. And you can borrow up to 50% of the value of the stock. So that's 2-to-1 leverage, right? But options are different. Options are already leveraged instruments. And so they don't let you borrow money to trade options. What they do is they have you post margin no matter what type of option position you have. Because there are some option positions, like naked selling options, for example, where you can lose much more than you stand to gain. Selling naked calls, for example, has theoretically unlimited loss potential. So every option position must be margined. Long options, that's basically just whatever you pay for the option is the margin. Short options, like I said, since you can lose more, they have a formula that tells you how much margin. Spreads, it's different for every type of spread. And so that makes it a little bit tricky to measure the capital that you allocate to a specific thing. If you are trading stocks, maybe you decide to allocate $20,000 to each stock trade. You know, it depends on the size of your account, right? If you have a small account, it'd be a smaller number. But if you have a bigger account, it'd be a bigger number. But if you decide to allocate $20,000 per trade, well, you can buy 200 shares of a $100 stock. Or you could buy 400 shares of a $50 stock. But when it comes to options, like if you're selling a put credit spread, you're not paying any money. You're collecting money. Even though you're not paying money, you've got to set money aside into a margined portion of your account, and you're not allowed to touch that money. And so, like that's the money that you look at. And what we do is we call it return on risk. That's how we measure our results when it comes to option trading. We look at what is my risk, which is generally what your margin is. That's not an exactly accurate statement, but with some spreads it is, you know, with some trades it is. So we look at what our margin is, and that is like the equivalence of, hey, here's how much I pay for a stock. Okay. And so all this makes it a little trickier too, because we're talking about trading, not investing. Trading and investing are two very, very different things. With trading, we're probably going to make a lot more trades, and they're going to last a lot less time. They might last just a couple of days or a week or 2 weeks, whereas an investment might last 2 years or 5 years or 10 years. So we would love to make money on every single one of our trades, but that is never going to happen. Sorry to break the news to you. I wish I could tell you otherwise. But even though you're not going to make money on every trade, that's not really the important part. The important part is your end of year results, right? If I make 300 trades within a year, and I started with 20 grand, and now I have 30 grand, I made 50%. That's pretty darn good. Even if, I mean, I could have had more losers than winners in that time, and it's still pretty darn good. So there are three. Okay. So the important thing here in an account is managing your funds. Okay. And there are three potential cash management problems. One is over leveraging. Because you can get pretty leveraged with option trading, you can end up in a situation where you could blow up your whole account and get a margin call and have to put more money in just to get back to zero. You might be undiversified. Now, diversified takes on a whole different meaning when it comes to option trading. In long-term stock investing, that could mean your 60-40 stocks and bonds, right? And then among your stocks, it could be some blue chips, some growth stocks, some value stocks, some emerging market stocks. That's not what this means. That's not what diversification means when it comes to option trading. When it comes to option trading, diversification means some long delta stocks, some long delta trades, some short delta trades, some long volatility trades, some short volatility trades, a mix of those four things. Another problem that you could have is holding too much in cash. Now, if you are pretty new to options, you're going to want to hold a lot in cash. You're going to want to trade very, very small until you can prove that your theory works. If you come up with a system that says, hey, when the 21-day moving average crosses above the 50-day moving average and implied volatility is in the bottom half of the 6-month range and RSI is this, then I'm going to buy the 30 delta calls. Okay. That might all make sense. Once you get about 30 trades done, then if you have more money than you started with, you're probably doing something right. Then you can use more cash. How much more cash? We'll talk about that later if we have time. But once you do have an established system, if you're only trading like 5% of your money, you're not doing a good job. You need to maximize that. So how do we optimize it? Well, there's three focal points that address the three problems. As far as over leveraging, we need to structure positions properly so that we're not over leveraged. If we're undiversified, we need to balance that portfolio. And if we're holding too much cash or not enough cash for that matter, which is part of 1 and 2 here, we need to look at our cash reserves. So let's start out with leverage and allocation here. Let's say you study a stock and you look at the chart and you are bullish on this particular stock. And so you want to buy calls. Okay, great. Well, I just got done telling you, you've got to think through how much capital you're going to put in the call with things like margin and such. Well, let's really make this very, very simple and drill down so that you can kind of see how this feels in real life. How many calls would we buy? Let's say I got a typo here. Hold on a second. Sorry about that. Let's say, well, one thing is that 100 shares, if I exercise one call, I buy 100 shares, right? But what if I want the exposure of 100 shares? I want a risk that is like owning 100 shares, but I want to do it maybe a little bit safer by buying a calls and maybe a little bit more leveraged. Maybe I don't have, maybe it's $100 stock or something, or maybe it's a, $50 stock and I don't have $5,000 free. So I'm going to buy a call instead. I'd like to buy 100 shares. That's how much exposure I think is appropriate. Well, if I want the exposure of 100 shares, how many calls should I buy? Well, there are two considerations: capital outlay and delta. Who remembers what delta is? I bet somebody remembers what delta is. What is delta? Well, delta has four different definitions. And this just represents a couple of them. Delta, their textbook definition of delta is the rate of change of an option value relative to a change in the underlying stock. So that means if the stock goes up by $1, how much does the call go up by? How much does the put go down by? So that's what delta is. And it's stated as a percentage. If the stock goes up by $1 and the call goes up by 35 cents, well, that's 35% as much of $1, right? So it's got a 35 delta. And it can be thought of as the number of shares or futures, if we trade futures, of the underlying represented by the option. So if you think about it, let's say I buy 100 shares at X and it goes up by $1. Okay. And if I own the stock, I'd make $100, but I own the stock. I own a call. It has a 35 delta. It's going to make 35% of that much, right? So it's going to make 35 cents per call. If it makes 35 cents, that's like owning 35 shares. If I own 35 shares and it went up $1, I'd make 35 cents. So that, like, if you take that away from today, especially if you're newer to this and delta is a new concept to you, if you take that away from today, man, that is profound. That's going to take you really far. Think of delta as the number of shares of the underlying that you quote unquote own. Okay. So if you think about it, that means delta is effectively a measure of the leverage of an option. Because look, let's say I have a $50 stock. Well, stock has 100 delta. Okay. 100%, 1.00. Because it acts like itself, 100% like itself. If it goes from 50 to 51 and I own 100 shares, I make $100. But what about the 50 strike calls that I would buy at $4 and they have like a 50 delta? What if I bought 2 of those calls? Well, if I bought 2 of those calls, each one costs $4. So that's 2 times 4 is $8 a share. And each call represents 100 shares. So that's $800. And each one has a 50% delta. So 2 times 50 is 100%. So, hey, that's just like 100 shares. Buying 2 50 delta calls is like buying 100 shares as far as delta goes. But it's different in another way, right? I would have to pay $5,000 to buy 100 shares at $50, right? And then if the stock goes up $1, I make 100. If it goes down $1, I lose 100. Straightforward. But if I buy 2 of these 50 strike calls that have a 50 delta, I'm only paying $800. I'm paying significantly less. What is that, like 16% as much? Big difference. And if the stock rises by $1, I make about $100. And if it falls $1, I lose about $100. Now, okay, I'm looking now for our more experienced folks here. Why, if the stock goes up by $1, I make 100, but if the stock goes up by $1 and I own the call, I only make about $100. What's with that about? Who can tell me? Who can tell me? Hit that Q&A box. You are going to win something very, very special for the first person to give me the right answer. Bragging rights. Good job, Justin. Justin gave me one of the very, very key things. Says volatility goes down. Hey, Larry, how are you? A lot of the times when stocks go up, implied volatility goes down. So I might make $100 on the delta of those 250 delta calls. But if volatility goes down, I'm going to lose a little bit on Vega. Very good, Justin. Also, what if it happens over a 3-day period? Well, then I'm going to lose some on theta. Also, what if, well, it has gamma, right? Not even what if, I mean, it has gamma. And I know that if I own a call, I have positive gamma. And so as the stock goes up, my delta gets bigger because the call gets more in the money, right? So my delta is going to grow at a faster rate. So gamma makes it grow at a faster rate. Theta makes it go down. Implied volatility probably makes it go down, although there are some stocks where it makes it go up. And sometimes, that relationship, of course, only holds true about 80% of the time. So, there's a lot more play there's a lot more play when it comes to options. Not that it's loose. I mean, you can measure them all by using the Greeks, gamma, vega, theta, but we got to know that. So we can take everything we just talked about and talk about the formula for leverage when it comes to options. We take the delta times the option quantity, and that equals the equivalence of shares of stock. And this is just what I was talking about before when I said, think of delta as the number of shares. But I went through an example where it's one call. 135 delta call is like owning 35 shares. What if you own 235 delta call? Well, that's like owning 70 shares. How about 3? That's like owning 105 shares, right? If I buy 425 delta calls, that's like 100 shares. 1030 delta calls, it's like 300 shares. 540 delta calls, it's like long 200 shares. Couple of caveats here. Leverage has benefits, but can be dangerous. It is a double-edged sword. The call is not a perfect substitute for the stock because deltas change, gamma. And we need to understand those other influences, time and volatility. All right. So I think you get it, but let's go through an example with using a long put because it's a little bit different with puts. Let's say same scenario. You're looking, your moving average crossover thing and the RSI thing and all these things happen, and that triggers your bearish trade. Time to buy puts. But how many puts should I buy? Well, when it comes to puts, oops, I got this typo in here again. When it comes to puts, same thing. 100 shares, if I exercise one put, I get short 100 shares. But what if I want the risk of being short 100 shares? Like my worst case scenario is it goes up $5 in my mind, how I'm modeling it out. And I'd lose, 500 bucks. Okay. That sounds like enough risk. If I was short 100 shares and it went up $5, I'd lose 500 bucks. Okay. I want the exposure of being short 100 shares. So how many puts do I buy? Well, I've got to consider it's a little bit different. Like I said, capital outlay and margin as well as delta. So if I'm selling short 50 delta stock, goes down $1, I make $100, up $1, I lose $100. What if I buy some puts at $3 and they have 50 deltas? Well, if I buy 2 of them, 2 times 3 is 6. So that's $600. And if they have 50 deltas, buy 2 of them, that's 100. So it's like being short 100 shares. So let's compare. A little different here. So short 100 shares, how much do I pay to get short 100 shares? Who can tell me? Of a $50 stock. I'm being a big jerk because I'm trying to trick you. You don't pay anything. What you do, well, there is a fee to do it, but it's comparatively small. What you do is you borrow stock, and there is a cost to borrow, but it's very, very small, usually. You borrow shares of stock. Right. Yes, Larry. Right. You borrow shares of stock, and then you sell it, and you get that money put into your account. I've been loaning out some shares, and Larry, it sounds like you're familiar with this. Sometimes, sometimes, with the hard to borrow stocks, you loan them out, and you make a lot. The fees can be high, but I don't want to complicate matters here. So really, though, you get $50 per share, $5,000 cash into your account. But, Firstrade's going to have you put some aside for margin. And then there is the locate fees and that kind of thing. So it does cost you, well, the margin is not a cost. You're not paying that. It's still your money, but it's partitioned into your account in such a way where you can't use it because it's tied up in margin. So you're posting a very, very small amount of money. So it's already naturally leveraged. And a lot of times that can be like 5-to-1 leverage. It depends. You got to talk to the good people here at Firstrade about that. But if the stock goes down $1, you make $100. If it goes up $1, you lose $100. Little leveraged, but very straightforward. If I'm buying puts, well, there I know how much I'm paying, and I'm actually paying because I'm buying the put. If I'm buying 2 at $3, each one represents 100 shares, so that's 300 each. So that's a total of $600. Stock falls $1, I make about $100. Rises $1, I lose about $100. Why? Same reasons: gamma, vega, theta, right? But this whole margin thing kind of goofs everything up. But the formula for options, it's exactly the same. As long as you understand the Greeks, trading options in a lot of ways, in my opinion, is easier than trading stocks. You know exactly what you're paying for it. You know exactly how you're going to make or lose your money. Whereas, shorting stock, it's a little messier. Like, what are the, location fees? What are the, how much do I need to put in margin? Do my fees change on a day-to-day basis? Is there interest on the stock? There's all these questions. Options, you tell me the delta, gamma, theta, vega, and I can tell you exactly if the stock does this, here's what's going to happen. Okay. Same caveats though, right? The only caveat that I'm adding is margin issues, which we just talked about. Okay. So now let's talk about balancing an option-centric risk in a portfolio. So this, friends, oh boy, this I really like. You're going to like it too. So we talked about diversifying here, right? So when it comes to option trading, you got your delta. I lump gamma and theta together because they're kind of like opposite sides of the coin of each other, and vega. But gamma and theta are really your realized volatility. If there's a big move in either direction, how much do I make or lose? Well, gamma is going to be a big part of that. But I pay for that gamma with theta. Or if I'm trying to make by selling options with theta, then I have negative gamma. I pay for that benefit of positive theta with negative gamma. And then vega is your implied volatility risk. So really, you got two risks, right? Direction, which is delta, and then volatility. And volatility kind of falls into two categories: realized volatility or historical volatility, and implied volatility. Now, let's talk volatility for a second. Volatility is, in and of itself, an asset class. You might not have ever thought about it that way. Like right now, if you're doing, you're saving for retirement and such, you probably have stocks and you have bonds. And maybe you have real estate, collectibles, precious metals, gold, maybe some people have. Forex, maybe. So volatility can also be thought of as an asset class because that is part of what you're trading when it comes to an option position. And you can isolate it. I mean, heck, just doing something like trading the VIX or VXX or UVIX. I mean, you can just trade pure volatility. So profits in the volatility position, which, is all option related, I say they're independent of market movement. They're somewhat independent of market movement. There is a correlation with some stocks, with most stocks, which holds true about 80% of the time, but 20% of the time it doesn't hold true. And with some stocks, it's reverse correlated, negatively or positively correlated. So I do invite you to explore looking at volatility as an asset class, which might mean VIX or VXX. But even if you are buying a call, you're still making a trade in volatility. In fact, you can think of any option position as three different trades. The trades are directional trade, which is your delta, which is just like buying or selling a stock. You have a position in the gamma theta relationship, realized volatility, and you have a position in implied volatility. You have all three of those things on with one instrument. And so we need to diversify these things. We need to diversify direction and volatility. So here's what I'm going to say. If you have a certain number of option positions in your account, maybe it's 3, maybe it's 5, maybe it's 10, maybe it's 30. If every single one of them is positive delta, you're doing it wrong. You're not taking full use of options, and you're not very diversified. So you should have some negative delta trades too. And now you might think to yourself, well, I don't look for that. So how am I supposed to find a negative delta trade? Like now I have to learn a whole new strategy. Well, a couple things. One, the more you learn, the more you earn. So it doesn't help or hurt to learn a new strategy. But the second thing is they're actually easier to find than you think. If you have like one strategy that you're good at, and that's finding bullish breakout momentum, whatever trades, if you're looking for those, how many times, for those of you who do follow a specific system, how many times have you followed a system and searched for trades within your system, and you come across one stock that you think, oh, this might be good, and you're like, oh, geez, no, this is a terrible one. I'm not going to trade that. Well, if you found one that is so terrible for a bullish trade, it might just be a bearish trade, right? Not always, but sometimes it is. So you can come across these more easily than you think. But we also want to look at, so that's, that's easy, but you just got to pay attention to it. And then I'm going to talk about sliding risk, and I'm going to talk about risk thresholds as well. These are important concepts, and nobody talks about these. When I was trading on the floor of the Chicago Board Options Exchange, I had a guy who was kind of my boss. I mean, I guess he was my boss. His job title was risk manager, and his name was Bob. So Bob, when I first started trading, would say, all right, Dan, you're allowed to have this many deltas. Dan, you're allowed to have a theta, a negative theta that is less than anything up to $1,000 a day. It got bigger, obviously, as time passed. Dan, you're allowed to have a vega of whatever. He set parameters. Now, we'll talk about that in a second. But one of the parameters he set was a parameter for gamma, but gamma is very difficult. I'm going to show you how easy it is to set parameters for delta and theta and vega. But gamma, geez, I mean, even if you can get the gamma figure, gamma changes, and it's just so hard to know how much could I lose as a result of gamma. Is this gamma too big? Is it too small? I don't know. So what you want to do is look for specific, well, you want to look at what's called your sliding risk. And that measures the risk of large unexpected directional moves. And you say, okay, if the market's down 10%, how much do I make or lose? If it's up 10%, how much do I make or lose? If the market's down or up 20%, how much do I make or lose or make? If the market's up or down 30%, how much do I make or lose or make? And you literally want to look at it at benchmarks like that. If it's like 1%, it doesn't matter. Like, that's not sliding risk. That's just look at your delta. We're looking for big, scary, unexpected moves, especially big, scary, overnight unexpected moves, which don't happen that often. They barely happen. But when they do, I mean, look at your account right now. If the market opened 20% lower tomorrow morning, like say the market closes tomorrow morning, it opens 20% lower tomorrow morning. How much would you lose or make? It could be make too. I can give you a hint. It's not 20%. With options, they're leveraged. there's a pretty good chance, especially if you do a lot of option selling, that you're going to lose more than 20%, maybe a lot more. So we need to at least think about this kind of thing. So now let's talk about risk thresholds. So the delta of individual option positions, we want to set a threshold for it. We want to set a limit for it. And you can beta weight it if you want to. I'm looking at this. I did a presentation on this in China, and I think I mixed up the slide with the Chinese one. Because anybody here trade Dalian soybean meal? Anybody here trade Dalian soybean meal? No, nobody trades Dalian soybean meal. Okay. SSC 50 futures contracts. Anybody? No, nobody. Okay. So anyway, you want to look at your deltas and say, okay, look, if this stock is down 10%, well, how much is 10%? Well, it's $50 stock. Okay, if it's down $5, how much do I make it lose? If it's up $5, how much do I make it lose? As far as the make part goes, bring it on. The more I make, the better. But I care about losing. And sometimes, if you stand to make a lot, you stand to lose a lot, more often than not. So we care about how much you can lose. And then we want to take the delta of your portfolio. So this is where you really want to beta weight your deltas if you can. And how do you do that? Well, I mean, you can do it in a spreadsheet. As far as the beta, you Google what is the beta of Amazon? What is the Google of, well, what other stock do I have? Oh, Ford Motor Company. What's the beta of Ford? And you beta weight them. And you probably want to use dollar deltas, but that's a conversation for a whole nother time. And then beta weighting is just doing this. Beta weighting is saying, hey, I own 100 shares of Amazon, but I also own 100 shares of Tesla. Well, which one moves more? Well, Tesla. Okay. So 100 shares does not equal 100 shares because I have more risk owning 100 shares or 100 deltas of Tesla than I would with Amazon. So if we beta weight them, which is basically using statistics, we use their beta. Beta means how much this acts like the S&P 500. Okay. And so in that example, Tesla's going to have a bigger beta than Amazon. So, we hold fewer deltas of Tesla than we would of Amazon. And then we have risk thresholds on theta and vega. So as far as positive theta, money we make as time passes with our option positions, well, same thing. As much as that as we want, but if we're short options and making money on theta, that means we're losing money on gamma. Or we have gamma risk at least. So what we really care, and that's going to be measured by the sliding risk. What we really care about theta is what is the maximum negative theta threshold? And you set that for individual positions or for portfolios as a percentage of your portfolio. Use 0.5% per trade as a starting point. So say you have a $20,000 account. Okay. What's What's a 0.5% of $20,000? It's $500, right? So you would not want to be losing more than $500 a day on theta. And then with your portfolio as a whole, you're going to take all your positions. And remember, some are long volatility, some are short volatility. So they're not all going to be losing on theta. Some are going to be making on theta. And so we're going to set that as a threshold of the portfolio too. And then finally, Vega. Risk managers set maximum positive or negative Vega thresholds. And if you set these for yourself, just create it in a spreadsheet, thumbtack it to the wall next to where you trade and say, I will never have a negative theta bigger than this. I will never have a Vega positive or negative bigger than this. It's going to keep you in line. It's going to keep you from taking too big of a position. And then finally, friends, we have allocation and reserves. So, I already talked about diversifying between long and short, delta and volatility. But margin, like we pointed out before, is a measure of both leverage and protection. And so we're going to use some of these things to maximize our cash allocation. If we're not deploying enough cash, we're going to have low end of year results as a percentage, right? If you've got a $100,000 account and you're just trading like little one lot trades, oh, I bought a call for 75 cents. Oh, I made 50%. So there's $35 in my pocket. Well, I mean, that's 0.0035 of a percent. It's immaterial. It doesn't matter. You're not going to beat the S&P 500. You're probably going to have a lot of opportunity cost if you're not trading enough. And, you know, this is where it gets a little philosophical. Is it really more conservative to trade smaller? A lot of times that answer is yes, especially if you're newer to trading and you don't have a system that is proven to make money. If you come up with a very specific set of steps for trading, if this and this happens and this happens, that happens, this happens, this happens, this happens, that happens, that's when I make my trade. Okay, follow those rules exactly, make 30 trades. If you have more money after 30 trades than you started with, you've got a good system and you should be deploying enough capital. If you have a $100,000 account, you've got a winning system and you're only trading, buying 75-cent calls, one lots, you're doing it terribly wrong. But if you don't have a proven system and you have a $100,000 account and you're trading 75-cent one lots, keep doing that until you get a proven system. Because too much cash deployed means over leveraged, means not enough cash reserves for management. Talk about that in a minute. And if you don't have a proven system, you have no business trading that big. It's like poker game, right? Every now and then, a couple of times a month, me, my wife, a couple friends of ours will play poker. And it's a big tournament. It's a $5 buy-in. And we get all these chips. And winner take all. Whoever wins gets a whole, you win $15 on your $5. This is 4 of us usually. I don't have great poker skills. I wish I did. One of these days, I vow to study poker, but I haven't gotten to that point yet. So that's a good level for me to bet on a poker tournament. $5. That's good buy-in for me. I would have no business going to one of these like highfalutin underground poker things where the guy who played Spider-Man shows up and who else? Michael Jordan or who else? Who else plays poker? And who plays poker is The guy who played Welcome Back Kotter, Gabe Kaplan. He's a poker player. Did you know that? But I would have no business going and playing with those guys with like, a $10,000 buy-in because I would just get creamed. I don't have those skills. I don't have enough practice. I don't have enough knowledge. And same with option trading. Keep it small until you have those skills, and you can get them. If you want it, you can get it. The more you learn, the more you learn. Now, as far as cash reserves go, trading is fluid, which means things come up. You never want to have all of your cash maxed out. One is, there's a lot of reasons. One is new opportunities arise. If you got all these trades on and, you max out all your cash and you're sitting there and you're looking at the market and you're like, holy cow, look at this trade. Oh, this is great. It's like an arbitrage opportunity. I don't have enough cash. Darn it. Oh, well, I guess I got to miss it. Not good, right? Or I did a Firstrade webinar on adjustments. You need cash to adjust. I remember one time early on in my covered call trading career, I was trying to close a covered call to reduce risk, and I didn't have enough cash to buy the callback. And I called him up. I'm like, how can you not let me buy the callback? I'm literally reducing risk. They're like, yes, it'd be good if you reduce risk, but you don't have the cash to buy it. There's not cash to pay for it. You might have a personal family emergency, God forbid. I hope you don't. Hope I don't too, but life happens. Sometimes you need to just get money desperately right now. And options are already leveraged. You don't want to overextend. And here's one more. Cash is an asset. Sometimes holding cash is a better opportunity than holding anything else. There's inflation. It is basically a decaying asset, so that's not usually the case, but sometimes it is. And then reserve balances. Some traders trade what is called the 90-10 rule, which is like if you're just buying options, keep 90% in cash and buy options with the other 10% because they're leveraged. I don't know. Personally, I don't think that makes sense, but some people do that. Depends on the market too. Like I said, cash is an asset. It is an investment. Opportunity cost, right? You can miss opportunities if you don't have that cash. So general rule of thumb is you should have between 15 and 30% of your account value should be held in cash. Now, if you're brand new to options, you're just starting out, you don't have a proven system, it should probably be 90% in cash, 95% in cash. But the more adept you get, the more you've proven to yourself that you're able to make money consistently over the long run. It probably ends up being something like 15 to 30%. All right, friends, do we have any final questions before we call it a day here? Well, then, thanks for attending this webinar. And I'm going to see you next week where we talk about choosing the optimal strategy to maximize your risk reward. That's an important one. I will see you then, friends. Have a great rest of your day. Trade smart. See you, Michael. Bye.